Cryptocurrencies are a complex technological phenomenon. They are entangled with many other aspects of human society. Their scope goes beyond computer code. If it was just computer code, you could copy and paste Bitcoin's code and create another Bitcoin. Of course, this has been tried literally thousands of times, but it doesn't work. Bitcoin itself was conceived as a peer-to-peer electronic cash system, but after it was released to the world and began interacting with people, it took a different path. People prefer to use Bitcoin purely as an investment, a store of value rather than a payment system. There is a strong demand for an investment that can be used to protect your funds from the inflation of the world's monetary system. But in practice, Bitcoin as a long-term investment has outperformed all other investments, including gold, real estate, and the stock market. After more than a decade of data on Bitcoin's price, we know that it has been an extremely good long-term investment. But in the short term, fluctuations in price are very dangerous. Seasonal tokens have been designed to solve the problems of cryptocurrencies as an investment. Seasonal token system is a financial instrument designed to cope with the big volatility in the cryptocurrency markets and the seasonality produced by Bitcoin's mining supply. In order to understand seasonal tokens design, let's take a look at the historical Bitcoin price. Bitcoin's price is determined by the mining supply and public demand. Mining supply is determined by the code, and demand is a random variable depending on so many factors impossible to predict. Every 210,000 blocks, the mining rewards are cut in half. This halving of mining supply effectively doubles the cost of production overnight. This graph shows Bitcoin's price history. The blue vertical lines mark the halving of mining supply. Despite the large variations in price, a pattern can be observed. In order to visualize the broad picture, let's change the chart to a logarithmic scale. Same data but focused on order of magnitude changes. Notice that the average Bitcoin's price is steadily rising. This shows that proof-of-work mining effectively puts upward pressure on the price. Months after the halving, the price rises to a local maximum, and then falls to a local minimum, eventually recovering, trying to find a new equilibrium, until the next halving causes another large perturbation in the economy. The problem with proof-of-work mining is that mining Bitcoin becomes much less profitable overnight when the halving occurs. Bitcoin's price would have to double to make mining as profitable again. This leaves some miners out of business because there is no other cryptocurrency big enough to switch the mining power to. After the local maximum is achieved, a bear market follows. The situation can last more than a year. During all that time, investors are losing money, and there is nothing they can do about it. If there was another cryptocurrency whose price is rising while Bitcoin's price is falling, it will open the possibility to move the capital to that cryptocurrency to avoid Bitcoin's bear market. However, the price action of all other major cryptocurrencies is highly correlated with Bitcoin. They follow Bitcoin's bull and bear markets. So there is no other cryptocurrency to move the capital to. Seasonal tokens solve these problems by creating 4 proof-of-work tokens running on the Ethereum virtual machine. The tokens don't need their own blockchain, transaction records and the security of transactions are handled by the Ethereum network. Their mining supply is specified in time, so that every 9 months, one of the token's mining rewards will be cut in half. This makes sure the relative prices of the tokens oscillate around one another, independently of the external market conditions. Let's walk through the whole process to see how this works. When the Spring token mining rewards are cut in half, mining Spring becomes instantly unprofitable. Miners stop mining Spring and concentrate on the other 3 tokens. But with more miners competing for the other 3 tokens, every miner gets a smaller share of the tokens produced. Therefore, halving Spring rewards makes mining Spring unprofitable and reduces the profitability of mining the other 3 tokens as well. In order to recover the mining profitability, Spring's price has to rise relative to the other tokens. But miners don't control the prices. Investors who hold the tokens are the ones with the power to trade one token for another and shift the relative prices. Seasoned investors know that the relative prices of the tokens oscillate around each other, and the cheapest token eventually will become the most expensive of the 4. They can trade the most expensive tokens for a greater number of the cheaper ones, increasing the total number of tokens they own. They can transfer capital to the cheapest token in anticipation of future profits. In doing so, they cause the cheapest token to rise in price until it is profitable to mine the token again. This in turn causes the mining power to distribute again among the 4 tokens, further increasing mining profitability. Seasonal tokens solve these problems in a very organic and efficient way. Because what is a problem for miners is an opportunity for investors. A collaboration emerges between miners and investors. Investors help the mining economy to remain efficient after the mining rewards are cut in half, and in return, they increase the number of tokens they have. Investors share part of the economic value produced by miners by producing a valuable service to the mining economy. It is important to notice that this collaboration is not an agreement between miners and investors, it happens spontaneously, out of the conditions set by the mining supply schedule, hard-coded in the smart contracts. To summarize, most people are using cryptocurrencies purely as investments, a store of value rather than a payment system. Data shows that the Bitcoin mining supply schedule causes big perturbations in the economy, and other major cryptocurrencies follow Bitcoin's bull and bear markets. Seasonal tokens were designed to solve the problems of proof-of-work cryptocurrencies as investments. Halving the mining supply is a problem for miners, but it opens opportunities for investors to make profits. The collaboration between miners and investors is a more efficient way of producing cryptocurrency, and it is a unique feature of seasonal tokens design. Seasonal tokens give the unique opportunity to increase the long-term value of the investment, even during bear markets. Because trading expensive tokens for more tokens of a different type guarantees that the total number of tokens increases. And in the long term, all tokens will tend to have the same price. The ability to increase the total number of tokens over time is very useful. Because even if the dollar prices of the tokens remain constant, the long-term value of the investment grows.
To learn more about seasonal tokens, please subscribe to our channel. Click on the bell icon to get new video updates.